welcome to the Monday Futures Market Outlook for August 20th, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out the eminisource.com trading room, complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures, and we have seen the US dollar continue to consolidate off of its July highs. Really, at this stage, we're at a very crucial level. This sideways consolidation is coiling up. What will inevitably be some form of a market move. We could still see a very quick burst to retest the 81.75 focal point, give or take 25 cents. But if that support line holds, we still are pretty adamant that the US dollar could move higher here, not only back to 84, but still yet finish a trend up to 85, 86 or higher on the upside. But a lot of whether that thesis happens is going to be whether that support line holds. Any substantial price action below the 81.50 level would certainly have to have us rethink our different scenarios. Next year I want to take a look at the Euro futures, and the Euro as it crosses against the US dollar is one of the key components of the reason for being bullish the US dollar. The Euro continues to struggle up along these levels, creating sort of like a rising flagging formation, very similar to what it did in the month of June. And really at this juncture, this is going to be crucial, even though the Euro here, if it holds these lines, could still burst up and hit 125, even 126 on the upside, marked off by that blue box. But in the bigger picture, if the Euro begins any weakening cycle, it could weaken all the way down to 118 or lower, which would certainly be a bullish catalyst for the US dollar. And so we're going to be watching the Euro and the way it behaves. A lot of we're seeing a lot of price action in the British pound, and so obviously the Swiss franc being pegged, that is influencing this market. And so we're going to see whether or not that rolls everything over here. Next year I want to take a look at the 30-year Treasury bond, and this is where we've seen the vast majority of the stimulus coming for the stock markets. The bonds had a very material correction off of their highs, and have now come to an absolutely crucial support that they've held for the last two trading sessions. That 145.5 level, give or take a half a point, has been the place where all the highs occurred in the months of December, January, and February. And we'll see whether those previous highs act like support. We're also seeing this is the zone where there's Fibonacci retracements. This is a very compelling level to be watching the bonds, not because it's turned around the trend, but if bonds were to make a short-term bottom and subsequently attempt a reversal and a rally the way they did back in March, it would be somewhere off of these levels, give or take a couple points. And so the risk-reward proposition of bonds here is pretty interesting, even though there's is very evident that the last few weeks have been very distinctly in a downtrend. Next year, I want to take a look at copper futures, and copper continues to be relatively weak. We see that copper continues to trade right near the bottom end of its ranges. There's a very important support line around that 330, 325 level, where all the lows have occurred in the last few months, and we see that the copper cannot really gain any strength off of that level. The longer copper stays here, the greater the probability it's going to give out and actually continue to weaken here, and that certainly would be stimulated by a strong US dollar. So a lot of this can, from an intermarket perspective, all come together in unison. Next year I want to take a look at crude oil, and crude oil is at a very interesting level. We've been suggesting that this 98 level on the upside is the top end of the sort of consolidation Fibonacci range that we were looking for. Not only that, that also lines up with where all of the lows have come in the months of December and January for crude. This could become overhead resistance and level where crude could naturally distribute. This is going to be an important level to observe whether or not crude rolls off of this level or not. That doesn't mean this is imminent. If we did see crude oil roll over off this level, it could come in the form of double tops or even a little mini head and shoulders pattern that could still play out for many weeks. So we're talking about an important price level, but not necessarily something imminent. Next year, when we take a look at gold futures, gold continues to be fighting up along its overhead resistance levels at 1625 to 1650. This is going to be a very important level because gold has been trying to edge and work its way higher up towards these overhead resistance levels. It needs to make a substantial and material break above this zone in order to become bullish. It would actually be very bearish for gold for it not to be able to exceed these highs. If we see a rejection here, the best case scenario becomes a retest of the previous lows in the 1530 to 1550 level, but there's still a measured move that targets 1450 on the downside. Finally, I want to take a look at the S&P 500, and we've seen obviously this bull push last now 3 weeks after the breakout. This really is a make it or break it level for the S&P. We have now tested all of those previous highs in this double top fashion, and this would be a very natural place for the S&P to roll over and go through some sort of corrective phase, maybe even as low as the 1325 level, give or take. But really at this stage, in the same regard, we could also see a very quick burst higher as a little short squeeze occurs, causing a lot of those predominantly bearish traders to get squeezed a little bit in their positions. If we do see a break to a higher high, for the 1435, 1440 is our initial target, but we do believe that the risk reward proposition of being in the S&P 500 here is very poor. And so while we're not suggesting anything is imminent, we are at critical price levels. We have an overbought market, and if it was given a catalyst to begin selling, this would be a place where there is potentially a substantial amount of downside risk. When taking a look at the key intermarket observations, we changed around the way we present this information. We're looking always at the short-term risk-reward proposition as well, just to identify long-term trend. Right now, we consider the risk-reward proposition of owning U.S. dollars to be good, as we're coming to a major support line and in a primary uptrend. And so owning U.S. dollars here is a reasonable proposition. To the same degree, commodities have been trending higher in the short term, but the primary trend of those commodities has been down, and so after there's been a rally, we even wanted to suggest even a poor proposition, but at this point we're going to just leave it even just at average to poor proposition for being in commodities. From a bond perspective, now that we've had that correction, we've had a primary uptrend in bonds, and the correction is now coming to key support lines, so the risk reward proposition of attempting long trades off of these support lines represents a good risk reward payoff. In the same regards for U.S. stocks and global stocks, whether they've been range bound or in an uptrend, after such a substantial rally, the risk reward proposition is substantially diminishing in terms of value of staying long the market, and particularly in adding any additional new longs. And so right now that's where we stand from our bigger picture. That was your Monday Futures Market Outlook. Thank you for joining me.